First Pacific Advisors appreciates its long-tenured partnership with Nedgroup. The Global Flex Fund gained 7.2% in 2023's fourth quarter and 18.5% for the trailing 12 months, ahead of the fund's performance indicator and the World Value Index, but behind the MSCI World Index. Other than 2023's fourth quarter, the fund is ahead of its performance indicator for all of the more extended periods. A small number of mega cap companies drove stocks last year. The average price increase of what some now label the Magnificent Seven, Apple, Alphabet, Microsoft, Amazon.com, Meta Platforms, Tesla, and Nvidia, ended the year with an aggregate value of almost $12 trillion, more than the UK, Canadian, and Japanese stock markets combined. Their 111% return in 2023 accounted for more than 75% of the 26% total return of the S&P 500. The average stock, however, delivered a much lower return, with the equal-weighted S&P 500 gaining just 10.4%. In the trailing 12 months, the Global Flex's top 5 performers contributed 8.9% to its return, as you can see on this slide, while its bottom 5 detracted just 0.9%. Other than Meta, Alphabet, and First Energy, we have talked about most of the contributors and detractors in commentaries and calls over the last year. Let me remedy those 3 companies now. Meta saw a welcome recovery in engagement and revenue year to date through following a tough 2022. The company has continued to offer customers new solutions that allow advertisers to target customers effectively and efficiently via one of the world's leading digital platforms. Moreover, operating profits are rising due to an organization-wide focus on improving productivity and accelerating the time to market for new products. Overall, profitability continues to be weighed down by losses in the Reality Labs segment. Still, on the positive side, Meta may emerge from the AI arms race as one of the leading players in the industry. Alphabet continued going from strength to strength during 2023. Despite concerns, the competition may infringe on the company's dominant position in search. Thus far, Alphabet has continued to hold its own, and we look forward to seeing how the company further incorporates AI developments across the Alphabet ecosystem. Lastly, we are hoping the impending arrival of a new CFO will bring a renewed focus on efficiency, an area where we believe Alphabet has ample room for self-help. First Energy is an Ohio-based public utility that we purchased back in 2020 in the face of a bribery scandal. The company paid fines and senior management changes as a result. Since then, the company has performed well operationally, which has translated into good stock performance. While increasing rates in 2023 caused its stock to drop from its highs, along with our interest rate caps, it continues to trade at a substantial discount to its peers and offers a 4.5% dividend yield. Global Flexible's net exposure, equity and bonds, declined from 68.7% to 63.6% year over year. That can largely be attributed to securities having met our price targets. We exited 6 positions in their entirety and sold part of an additional 5. We did initiate 10 new equity positions, but added to only 2 existing positions in the fourth quarter. There's nothing new to address regarding the fund's asset allocation composition, as it has mostly stayed the same since the prior year. Cash remains the most significant allocation at 36.5%, but the most prominent risk asset exposure continues to be the broad category of communication services at 14.2%. Almost 40% of Global Flex's equity exposure continues to be based outside of the United States. As we often point out, where a company trades is of secondary importance to the quality of a business and the price at which it trades. More relevantly, about 50% of the look-through revenues are from outside the US. As depicted in the bar charts in this slide, less attractive price to earnings and price to book valuations today relative to last year, particularly in the US, help explain the fund's slightly lower risk exposure. We are therefore grateful to be able to invest broadly as other parts of the globe trade less expensively. While the strategy's equity investments understandably trade more richly than year-end 2022, they trade cheaply to the Magnificent Seven, MSCI ACWI, and S&P 500, as reflected in the lower price to book and price to earnings ratios in the table, the shaded columns. But price without quality is like a crewless boat without an anchor, adrift without direction. What you pay for a business with attractive earnings growth, solid returns on capital, and sound balance sheets can offer a partial view of quality. Through that lens, you can see that the strategy's equities appear, on average, more attractive. Cheaper and better should translate into good performance versus the stock market over time. We believe our time will prove most valuable by deliberating on whether the companies in the portfolio and those that we are considering will meet our expectations over time, rather than trying to ascertain what inflation or interest rates might do, who might win the next election, etc. Bottoms up, that is, rather than top down. Fair question, and it remains frustratingly small. But the reasons for it are very simple. High yield bonds trade at a 7.7% average yield. Now that's higher than where it was, not that long ago, and but it's still somewhat lower than the 8.5% average and 21.8% peak that has been seen since 1996. And the current spread, which the current yield less than equivalent maturity U.S. Treasury bond, is just 3.6%, which is much lower than the 5.4% average and 19.9% peak that we've seen since 1996. And unfortunately, in the event of bankruptcy or restructuring, as lenders, we want to ensure we fully recover our investment. And the reason I say that's not unfortunate, but unfortunately, that's harder to come by these days, since covenants remain very much in the favor of the borrower. Covenant-like debt dominates the market, and we want to make sure that in the event that something goes wrong, we get the keys to the kingdom, and it's harder to get those keys. And the one that stands out and accounts for two of the names is commercial real estate. That was a big area of focus, in 2023 for us. The thought that employees might continue to work from home caused investors to run from the sector, as many believe that a double whammy impact of high vacancies and falling rents would be damaging. While true for many commercial real estate companies, particularly the more indebted firms with B and C quality properties, we don't believe that fear is universally true. I mean, while damaging possibly, but not irretrievably so. We were able to invest in a couple of commercial real estate investment trusts with A quality assets, less leveraged balance sheets, including some unencumbered individual properties. And these were trading at what we believe to be low teens normalized cap rates. We've also been looking for those businesses that were negatively impacted by high inflation that we felt in some cases would prove temporary, or the pricing would catch up to narrow the gap. The beer company, Heineken, for example, saw an increase in ingredients like hops, a big jump in their transportation costs, higher aluminum prices for their packaging. Now, some of these costs have already come down and pricing has gone up. In addition, management just completed a €2 billion cost savings plan and has more cost reductions on the way. So we are fairly sanguine about that company's prospects as well. Increased costs are a constant concern, and that's why we focus on those companies we believe can manage those cost increases that affect their income statement by the other part of their income statement, which is their revenues, by having pricing ability. So pricing capabilities and their strength, which is really dependent upon the strength of a company's business and where they sit within their competitive set, is an imperative as we look at companies over time.